The U.S. China trade war continues to take its toll on farmers across the country as it drags out. There are questions about how much longer farmers can wait it out. Joining us with more is Nate Kaufman, the vice president of the Federal Reserve Bank of Kansas City. He's based in Omaha and the Omaha branch executive. And what I wanted to ask you, and I appreciate your being here, is actually despite the floods and despite the trade war, there is some silver lining to these clouds, as the Kansas City Fed has reported, as things are stabilizing for farmers. Help us understand what is stabilizing.
I think the first thing I would say, and thanks Adam and Julie for having me on again, is that the outlook looks a little bit better than it had at the beginning of the year, but that doesn't necessarily mean that it's a positive outlook. I think that we've seen some revisions higher to farm income, maybe production expenses a little bit lower. One of the factors that has contributed to some of the overall strength still remains that farmland values, or the value of farm real estate, has been holding up pretty well. So there have been some silver linings, but I still would characterize it as a relatively downbeat environment with risks still high.
As I look at the credit conditions here, slightly more than 40% of bankers reported that farm income was lower. That is a lower number than we've got in 2016 and 2017. But if every year you have 40% or more of bankers saying that farm income is lower than the prior year, you've got a problem on your hands. What effect is this having on the overall economies in the areas covered here?
Yeah, that's right. That environment has persisted really for about 4 or 5, maybe even 6 years in some places. So we would characterize it as a relatively gradual deterioration in credit conditions. It does seem to be having a more pronounced effect, as you might imagine, on some of the more rural areas of the country, and specifically those in the Midwest and the Central Plains where agriculture tends to be a bit more prominent.
I am curious because the last time we spoke to you, it was about the tight credit conditions for farmers. Those seem to be easing a little bit or not. What are you seeing in lending? Because at one point, I think last year it was 90% of banks reported denying a request for a loan. Now it's down to 75%. And put that in context historically, where would that number traditionally be?
I think it's still showing that conditions are relatively tight. We've seen borrowing costs rise a little bit since a year ago with broader increases in benchmark interest rates. I think that there still is a lot of concern about what cash flow might look like within the agricultural sector, and so you're seeing some lenders still taking a very conservative approach to lending. Really, it is the past 4 or 5 years, though, and that gradual pace of deterioration. To put it into context, though, I think I would still say that it doesn't quite compare with what we would have seen in the 1980s, broadly referred to as a farm crisis. We just haven't seen conditions, credit conditions especially, get quite to that point. And a big part of the reason being the value of real estate.
Of course, the farm economy has changed quite a bit since the 80s as well. I mean, we talk a lot about the domination of large agricultural companies, but in many cases, are they still being supplied by small family farms, or are they owning and farming the land themselves?
That's a good question. I would say that it's gone maybe 2 different directions. What you've seen is maybe those mid-sized farming operations decide to try to take advantage of economies of scale, maybe get a bit larger. And so you've seen those mid-sized farms get larger, and you've also seen some still trying to stay small and nimble, which maybe means that they're trying to recognize new opportunities that have emerged in the market, value-added agriculture being an important piece of how they're thinking. So you've seen it maybe go 2 directions, but overall, conditions, I would say, still remain pretty tight.
One thing that's hard, farmers who have come on the program and explained to us, is trying to figure out what's going to happen with prices. Corn and soybeans specifically, because of the flooding and because of the tariffs, prices have gone up a bit. But I was curious, one thing that no one seems to be able to nail down yet is what the yield is going to be at harvest time. And with so much still in storage, what's that going to do to prices?
Yeah, and that really is true. There's still a lot of uncertainty about that. Earlier in the spring, many people remember that there were a lot of planting issues. It was a wet spring in large parts of the country. Many of the acres for corn and soybeans likely were not planted, but still hard to gauge exactly what that might look like. We obviously will know more as we get closer to harvest in the next 3-4 weeks. But that is one of the factors that has been weighing on prices, both in the up direction for corn a few months ago and more recently with lower prices.
All right, Nate, thanks so much. Nate Kaufman of the Federal Reserve Bank of Kansas City. Appreciate it.